Few weeks ago, at the start of the shutdown, I covered the systemic fragility in the US economy and how it's become this complex, tightly coupled system where small shocks can cascade into massive failures. And I explored multiple angles of weakness, but at that point, it wasn't really clear where the catalyst might come from. And it's looking more and more like it's hiding in the most boring place possible, which is the US Treasury bond market, supposedly the safest, most stable market in the world. I'm going to walk us through this piece by piece because it's a whopper, but it's eye wateringly technical. First, bonds. Bonds are how governments and companies borrow money. When the US government needs cash, it issues a bond, essentially a formal IOU. You give them money, they promise to pay you back later with a bit of interest on top. And so they get to keep running, and you get a bit of return down the road.
I salute the boys and girls who are buying United States savings stamps and bonds through the Treasury School Savings Program.
Some bonds mature more quickly and others more slowly, and each kind has a different percentage of interest attached to it. For decades, this system worked really well. Foreign central banks bought US Treasury bonds and held them long term because they were considered the safest investment on the planet. The US was stable, predictable, and it always paid its debts. But that's changing. With the US debt now exceeding $36 trillion dollars and increasingly erratic policy decisions, foreign central banks are backing away and they're selling their holdings and looking elsewhere. The reliable long term buyers are leaving the market. So, who's picking up the slack? That's where things get not great. In mid October, the Federal Reserve discovered something kind of shocking. There had been a massive undercounting of Treasury bonds held by hedge funds domiciled in the Cayman Islands. The estimates had been that they were holding around 600 billion, but the actual number they're holding is 1.8 trillion. Overall, this means they constitute 6 to 7% of the 29 trillion treasuries market, but between 2022 and 2024, they absorbed 37% of the new treasuries market. That means these hedge funds are buying one third of the US debt since 2022. These funds are now the largest foreign holder of US debt in front of China and Japan. So, what are they doing with all of these bonds? I give you one guess. They're gambling. Specifically, they're running something called a leveraged basis trade. Here's how that works. Let's say I'm a hedge fund and I want to make a $100 million basis trade. So I go to a bank or a private lender and I put down 2 million of my own money and borrow 98 million to buy 100 million in treasuries. So I've now borrowed 98% of the money to do this. And this is an average percentage for these kinds of trades now. The 98 million the bank loaned me comes with an interest rate, of course. And so the lower this rate is, the better for me. I buy the 100 million in bonds and then have to post the bonds as collateral for my $98 million loan, which I'm now paying 5% interest on. I then go to an exchange and sell the contract to deliver that bond at a fixed price in the future, usually somewhere around 3 months. This future price is usually higher than the price right now because bonds yield interest. I've now bought $100 million in treasuries and I've borrowed at 5%. My futures contract says I'll sell the treasuries at 5.15% more than what I bought them for, implying an annual yield of 5.15%. Because treasury bonds are normally extremely stable, the price differences I'm betting on are tiny, fractions of a percent. So I'll potentially only make 0.15% profit on this trade, which is $150,000. Here's what this looks like from another angle. You can see that I've mobilized $100 million in treasuries to make 5.15 million, but it costs me $5 million to get most of that. So my actual profit is tiny. And this is why I need massive amounts of capital to make this work. And I need to keep doing it constantly. So I'm going to roll over those positions every day if I can to keep that money machine printing. So zooming out, we have trillions of dollars in treasuries financed by borrowed money that are being rolled over daily in bets on tiny movements in price. What could go wrong? Clearly, a lot. We saw a crisis in 2020 when COVID hit and everyone rushed for cash. Banks stopped lending overnight, and hedge funds running these exact same basis trades were forced to dump their treasury holdings immediately in order to pay back those giant loans. The selling became a stampede and prices crashed. The Federal Reserve had to step in at that point and buy over $1 trillion in bonds just to stop the cascade, but that was with far less leverage in the system than we have now. We now have two times the amount of money being borrowed versus directly invested, and three times the amount of treasuries tied up in basis trades. After that crisis, the Fed created something called the Standing Repo Facility, where banks can go as a lender of last resort to get overnight loans if the regular lending market dries up. That's now being tapped at record levels. Banks are going to the Fed for overnight cash because they're either unwilling or unable to lend to each other through normal channels. The SRF was created in 2021 after the COVID crisis and saw basically no usage until this year. Since September, however, it's seen activity pretty much every day. And on Halloween, the banks borrowed 50 billion, which is a record. And that's from a place with higher interest rates than is supposedly available on the open market. Those interest rates are tracked through a metric called SOFR, the Secured Overnight Financing Rate. It's essentially the pulse of the repo market, which is where these hedge funds are borrowing their money every single day. If we look at a bit of historical data, we can see that before COVID, these basis trades used to be reliably profitable at half of the leverage. During COVID, money was virtually free, and after, with the interest rate almost doubling, these trades are only profitable with huge positions and lots of leverage. Add to this that regional banks are under pressure from commercial real estate losses and recent bankruptcies, First Brands and Tricolor looking at you there. The government shutdown is draining liquidity from the system. And when the shutdown ends, the Treasury will need to issue massive amounts of new debt just to catch up, which will strain the market even further. Putting these pieces together, it's likely that a lot of the activity in the standing repo facility is being driven not only by the things that analysts have already identified, which is, the shutdown commercial real estate exposure to the bankruptcies, but also these giant hedge fund basis trade positions that are being rolled over every single day. We can think of this like the deep financial systems check engine light coming on. So, TLDR, the foundation of the global financial system, which is US Treasury bonds, is now substantially held by offshore hedge funds running enormous, highly leveraged, daily rolled bets that only work if nothing goes wrong. And right now, things are starting to go wrong. So, what could tip this over into a selling spiral? I'll be looking for things like a major hedge fund, private lender, or bank failing, a continued spike in overnight lending rates, a sharp, unexpected move in bond prices triggered by newly released government data, a poor debt auction after the shutdown, or contagion from any other market. So, stocks, especially the AI bubble, crypto, or commercial real estate that forces these funds to liquidate. If that happens and we get a wave of funds forced to sell their holdings, this will absolutely be the straw that breaks the camel's back in terms of the economy.